Welcome back. So we're talking macros now. S&P Global has increased India's FY26 GDP forecast to 6.5%. Their earlier estimate for the country was 6.3%. They're also expecting significant growth uptick in China, despite all the tariff conundrums. Vishrut Rana, economist Asia Pacific at S&P Global Ratings, is with us now. Vishrut, thank you so much for joining us on the show this morning. So we caught that note, quite interesting, because it's not just India, but you see more growth ahead in China as well. Just explain the thesis, because we still haven't seen the final word and the ink dry on the actual tariff. What is it that you're baking in your estimates when you increase GDP estimates for both India and China?
Yeah, thank you so much for having me on the program. It's always a pleasure. And indeed, in these volatile times, I think a forecast is always going to come with a wider band of uncertainty as the economic environment remains highly uncertain. But as you pointed out, one key swing factor turns out to be the tariffs and what we assume going forward for the trade environment. We currently believe that the Liberation Day tariffs that happened in the early part of May are unlikely to happen again, in the sense that we expect that the current 10% baseline tariffs that the US has in place are going to remain through the forecast horizon. In our assumptions, we assume that the US effective tariff rate will be at 15%, which is roughly the current level through our horizon. So that is one of the big drivers behind our upward revision in the region compared to our May forecast, when trade was highly more volatile and looking much darker at that time.
So what does this mean for, let's talk China, because when we're talking tariffs, obviously they stand to get impacted more. So you're saying effective final tariff for US at 15%. What about the tariffs on China? Because from 145%, then there was significant climb down. And exactly what are you expecting? A bigger uptick in China? What will drive it?
Yeah. No, that's a great question. So the 15% effective was on the global, from the US to the global.
From the US side, yeah.
Right. But for China, the level is closer to 40% in our estimate. So we estimate the US effective tariffs on China are roughly 40%, which is very steep. There is some diversion going on, in the sense that Chinese exports are going to elsewhere, to Southeast Asia, to Europe, before going onward to the United States. So part of that is happening. But of course, the bilateral trade between the two has climbed down quite sharply. But what does all of that mean for the Chinese economy overall? One, it means that there is a more adverse external environment, and that is baked into our forecast, which is one reason why we don't think that growth will hit the 5% target that China has in place at the moment. On the other hand, the more important part for China this year is how the domestic story plays out. So there, the property sector currently still looking a little bit adverse there in China at the moment. Consumer sentiment relatively cautious, despite some stimulus measures. Overall, the domestic economy is holding up a bit better than the external environment, which is leading us to revise our forecast higher, but still well short of the 5% target that the government has in place.
Okay, so now let's talk about India. The small increase in the forecast here, 6.5%. So what made you do that? Does it have to do with the easier monetary stance of the RBI? Your thoughts?
So definitely, I think one element to the forecast is this front loading of rate cuts that the central bank has engaged in. And we think that it will lift consumer sentiment, should lift credit growth in the economy as well, which has been slowing for several months. On the other hand, the RBI did move to a neutral stance, which means that there's limited further room for cuts over the horizon. We think about 25 basis points of further cuts coming up this fiscal. Overall, the growth environment for the domestic side of the economy has held up slightly better, which is the main factor driving up our forecast for the year. In terms of the trade and tariff environment, I think India, one sheltering part for the economy is that it is more services oriented, both in terms of trade as well as domestic activity. And the service sectors have so far largely been exempt from the tariffs and trade tensions, which is going to be a positive factor this year.
Okay. Vishrut, otherwise, I mean, how do you size up the overall macros here in India? Growth, you're saying 6.5%. The hope is that inflation will remain under control. I mean, the last print was below 3%. And now with the oil prices again stabilizing, how do you see the next couple of months play out here?
Yeah, there's a couple of key factors I think on the inflation outlook. The first thing is food prices, of course, which is the key for India, and with the Met Department forecasting above normal monsoons, that should bode well for agricultural produce, and that means food prices should be relatively contained through the rest of the year. Indeed, we think that inflation is likely to come in just at the 4% mark for this fiscal year. Helped by the lower food prices, the outlook for energy prices is key. In India, of course, the producers bear some of the costs of that energy price volatility. Some of that is smooth before going to consumers. However, we think that energy prices for now are likely to remain range-bound, despite the recent increase in geopolitical uncertainty. And this means that energy price inflation should be relatively capped. I think one key swing factor to point out is the core prices and the prices of gold, which are currently playing into the inflation outlook. But for now, this remains relatively contained. We're not overly concerned.
Okay. All right, Vishrut, we will leave it on that note then for today. Thank you very much for joining in. Appreciate you taking out the time.